had a ton of news this week, some of it not so good, and it all revolved around, number one, the economic news, and of course interest rates, and then what happened in the banking industry, and it certainly caught everyone's attention.
Right. I mean, we entered the week, we learned that Silicon Valley Bank basically had gone out of business and that the Fed backstopped the depositors, so that got things off to a kind of a rough start. In fact, that was the day the stock market bottomed for the week, and surprisingly, the markets themselves were fairly resilient. The S&P was up over 1% on the week, the NASDAQ up more than 5%, but small caps took a hit, down about 2%. So a mixed performance from equities, but we now have the FOMC meeting coming next week, and all eyes are going to be on the Fed.
Yeah, and of course, what happened with Credit Suisse and the European Central Bank, which is, of course, their federal bank, stepped in as well and made some news. But, of course, as you pointed out, our Fed is going to meet next week, and there's about a 50-50 chance that they may do nothing, not raise interest rates at all, and about a 50% chance that they'll raise it a quarter point. Either way, the more important part of that is what will the statement be after the notice that they give. Will it be a dovish statement? In other words, will they say that they're near or at the end of their rate-raising cycle is probably the most important news that we'll get.
Absolutely. We're going to get real clarity there because they're also going to release the dot plots, which is the various members' expectations about where they believe the Fed funds rate's going to go in the coming 6 to 12 months. So that'll be a real good indication because just a week ago, there was some thought that terminal rate might be north of 6%, and those odds have diminished dramatically.
Yeah, they spooked the market. There was an 80% chance that they were going to raise the rate 50 basis points. That is now at 0. So I made some news this week by saying that the Fed is both the arsonist and the firefighter, and in fact, they really are. They have, of course, put so much free money into the system and kept it around for too long, which caused inflation, and now they're trying to catch that up by raising interest rates. That has, of course, inverted the yield curve. Don't want to get too wonky, but that is really what the problem is that the banks have.
It is. It makes it very difficult for the banks to manage their assets and liabilities in a concurrent way. And really, the solution for the Fed isn't that complicated. To help fix the banking system, to support some of the actions that were taken this week, they need to make moves that will uninvert the yield curve. In other words, make short-term rates go down relative to long-term rates. And they certainly did this week. The 2-year note dropped over 1% from its high in terms of its yield. That's a move that the statistical models suggest would only occur once every 50 million years.
Is that right? I didn't know that. Well, I don't know. The investment world's been around for 50 million. But yes, of course, uninverting the yield curve means that they would go out into the open market and buy a bunch of bonds, which drives that interest rate down. So if the 2-year rate comes down and the 10-year rate is set by the market, that'll at least flatten out. That will help the banks and hopefully alleviate a lot of the fear.
And the other thing is, and I think people need to understand what we're doing in the midst of all this, we really did not make any major moves in terms of equity allocation or fixed income allocation this week because policy, remains in doubt. We really don't know how aggressive the Fed's going to be in terms of curbing inflation and how strictly they'll go after that 2% inflation target that they talk about. Also, we know that the probability of a mild recession certainly went up this week. Goldman Sachs now thinks it's a 35% probability. And finally, equities, if you strip out the FANG stocks, are trading at about 15 times, which is a pretty good valuation, but things have been worse in the past. We wanted to keep some dry powder and see how things develop.
And of course, you talk about the financial crises that we've had in the past, and you think back to 08 and 09, there's still folks that have PTSD from all of the fear that went through those times, and we don't want people to go through that again. And so we do have our finger on the pulse. We're looking at the interest rates. We're looking at how that affects not only the bond market, Danny, but also the stock market and the holdings that people have.
Dave, you've got a little police and fire in your family tree. Yes. I think every arsonist knows that it's harder to put out the fire than it is to start it.
That is really true. And of course, inflation can become more permanent if they don't address it. So they are in a tricky spot.